guys, welcome to Talking About Finance. It's Sunday, March 14th. My name is Dave Coker. 7 slides, 7 days. First of all, this is an interesting one. We all know the Fed has been printing lots of money. The policy response to the pandemic was to print a lot of money, borrow a lot of money, and this graphically shows the severity of that decision about how much money has been printed. It's really wild, and we will pay for this at some point. There's no such thing as a free lunch, and this is going to get a little painful before it gets better. Now, Mr. Biden is actually, since his plan is through, he's going to start to spend, taking a look at the Treasury General account where the money piles up from bond sales. They were selling a lot of bonds over the past year. We know that. And they were spending lower amounts of money. So the cash piled up. Even though America is still in debt, there was an awful lot of money that was piling up. And now we're starting to see this drawdown, and it's going to be rapid because Mr. Biden's spending almost $2 trillion, $1.9 trillion, and that may get revised up if it follows the model that we saw with the policy response to the global financial crisis. That increased about 16% over the next year after they got the initial plan through. We've never had, this is concerning because we've never seen a drawdown of the size, as I mentioned in the slide. Prior record was about 400 billion. All things considered, guys, this should be dollar negative, but we're not totally sure about interest rates. And once again, you can structure your portfolio to make money from dollar negative. I've got big positions in gold and silver, and they should do pretty well if the dollar declines in value and all other factors remain the same. Of course, interest rates are the wild card. That's the other consideration when trying to plot FX, foreign exchange rates. If interest rates soar, the dollar may maintain its value or even appreciate against other currencies. But still, we know the inflation is coming. Now, when they calculate and report inflation, it's very deceptive because they do it across a very, very wide basket of goods and services, most of which I don't use. I calculate my own personal rate of inflation, and I don't use these 440 odd factors that they include. Another thing they do, and we'll talk about that in a later video, is something called hedonic adjustments. Pure evil, totally deceptive. So the inflation is coming, guys. Here, this is off Economist. We've got commodity prices baselined at January 2nd, 2020 at 100. And you can see, with the exception of oil, everything is up. Soybeans, copper, gold, iron ore. All this stuff is starting to rise very sharply in a relatively short period of time. We'll have to see what happens here. Now, regardless, we got a lot of debt, but look at this. This is really curious. Americans have never been richer, as I mentioned in the slide. We see that household net worth soared well over 10%, from 118 trillion to 130 trillion in Q4 2020. Why? People just weren't given opportunities to spend money. And even if you were in states that didn't have a lockdown, a lot of people were intimidated. A lot of people refused. They did their own lockdown, just worked from home. Key drivers of the wealth, stocks, without a doubt. So almost $5 trillion has added to household wealth from stocks alone. House prices, about 1 trillion, and bank deposits are the third factor that were coming in. So we know the money is coming. Mr. Biden's pushing the money out. This is a really good one, because here what we're doing is we're looking at puts as a percentage of market cap. And we're just trying to get a feeling for how much puts are being bought. This is on the NASDAQ QQQ. And we can see here, guys, at the bottom, a very nice presentation. We can see that there's peaks. And we're running up right now. So there's a lot of investors, a lot of money sloshing around the stock market. And a lot of that is being put into put options. Now, this isn't terribly bearish for the stock market. There may be a case of not outright speculation, although it's possible. It may be a case of people trading intelligently. And what I mean by that is when you take a cash position on, when you buy stocks, say you buy Apple, you could be going long puts to give you some downside protection. We're not totally sure. We don't know exactly how these things are structured, but it is sort of concerning that we're seeing a sharp rise in puts at this time. And it's interesting. Now, we know that some Americans have benefited. Personally, I've done very, very well because of the lockdown, but then I have significant holdings in property as well as shares. So if you have a work from home type of job, a work from anywhere type of job, as some people are doing it, you can see that jobs are coming back if you're in the higher wage brackets. If you're in these lower wage brackets, no, it's very unfortunate. The jobs just aren't there. Remember, there's some 10 million people unemployed in the States, and I suspect the number is actually higher because we do know there's large numbers of people in America that work in the underground economy, cash in hand. Happens here in the UK as well. So how are they going to survive? This is troublesome. Fortunately, Mr. Biden's plan will cater for people who are unemployed and can't find work. But it's really fascinating. And once again, guys, if you're in the higher wage brackets, you've actually done fairly well. You could save money. We saw that in the wealth household wealth report slide just 2 slides ago. So it's an interesting presentation. But we know that bad news is coming. And this really got my attention. Now, I have a fairly large property business in the UK, and my portfolio has been performing very well. I haven't had any defaults, outright defaults. I've had, a couple tenants that have gone into what I call workaround or workout, and we worked it out. They lost their jobs and they couldn't pay. But property is a people business. It isn't like you see on TV where you immediately a victim, start the legal stuff off. I know there's some landlords that do that. I don't because, I mean, come on. People have enough stress in their lives already with the pandemic and with being locked down. And if they lose their job, you got to work with them. And I worked it out with my tenants. But in any case, guys, this really got my attention because we've got three different classes. And you can see non-Hispanic white, non-Hispanic black, and Hispanic. And guys, look at this. I mean, the lowest for owners, the lowest is 14.7% of those reporting have been behind on rent or mortgage. And these are owners we're looking at. On the mortgage, I should say, in the past 3 months. That's really amazing. That's a huge number. Normally, it's low single digits. It's well below 3%. This is wild. If you take a look at the all, you can see there is sort of a racial breakdown, a racial little bit of breakdown there. That non-Hispanic whites only 10%, non-Hispanic blacks about 13.9, and Hispanics roughly the same as non-Hispanic blacks, 14%. It's interesting. Now, unfortunately, I say the bad news is coming because there are prohibitions on evictions. There are prohibitions on foreclosures on mortgages presently. But those are not forever. And at some point, we have to assume that a very, very large percentage of these individuals rather, or families that are behind already, they will default. They'll hard default. And at that point, they'll be evicted or they'll have their properties foreclosed on and then they'll be evicted. So this is going to be troublesome. All right, guys, that's it for talking about finance. Thanks for your time. Have a great week. Bye.